Hi everyone, my name is Alec here at the Financial Consulate, and today I'm going to be giving you the best tax hacks every retiree needs to know. And you might be thinking to yourself, it is April, I just finished these last few months doing my taxes, I'm done with taxes, I don't want to think about it. But when it comes to tax planning, there are different times of the year where you have to be careful and you really think out strategically when the best time to do some tax planning is. And when's the best time? The present. So let's talk about some of pitfalls that a lot of people fall into when they're thinking about the tax planning that they're going to do. A lot of people will forget about their RMD and leave it until later in the year. Some people might say, what's an RMD? The RMD is your required minimum distribution. So that comes out of any pre-tax IRA or pre-tax 401k. And there's a lot of planning strategies you can do with that, and I'll go into those in a little bit. But you have to make sure that you are constantly looking at your RMD, making sure, okay, keep that in the back of my mind for later. You have to think about things like tax breakpoints. So if your income goes over certain levels and you're on Medicare, there are things called IRMAA, and these are your Medicare premium surcharges. So if your income goes up over a level, you pay more for Medicare. And these things can drastically affect your financial well-being if you just make a couple bucks more and then boom, you go over one of those Medicare surcharges, and now every month you're paying more for your Medicare premium. So always keep those in the back of your mind. You also want to watch for taxation on investment income. Things like capital gains, dividends, and interest. These things you want to be careful of. You want to make sure that you're not realizing too many gains in a year, and we'll talk about strategies you can do with those brokerage accounts and those investment income taxation. Also, don't forget to pay your quarterly estimates. A lot of people will forget about these and come tax time they go, ugh, forgot about my quarterly estimates, and they have a huge tax bill with interest and penalties. So I know this is coming out a few weeks after tax day, but if you forgot your first quarter estimate, make sure you go and pay that. You can always pay them late. There is a small fee for paying it late, but it's better to pay it late than not pay it at all. And then another big pitfall people fall into is not planning for their taxation on Social Security. And some people say, I don't even understand how Social Security is taxed. So if you look here on your screen, I'm going to throw up a chart, and you're going to say, hey, that chart really still doesn't help me understand how Social Security is taxed. So if you look, let's just assume a married couple. If your total Social Security plus one half that Social Security plus your AGI plus some other things, it's confusing, I understand. That if you're under 32,000, none of your Social Security is taxable. If you're between 32 and 44, that means up to 50% of your Social Security is taxable. If you're more than 44,000, now 85% of your benefit is taxable. Now you say, okay, that makes sense. You have to modify your gross income by throwing a couple other things in there, and then you look at that chart. But what gets really cool is if you can sort of plan out your income, you can really pay next to nothing in taxes. So I work with a client, and this client last year took out $48,000 from his investment account. It came up from a taxable brokerage account. Between him and his wife, they had about $70,000 coming in from Social Security, and then they did about $12,000 from their pre-tax IRA to charity. Now you say, okay, that's over $100,000 of income. Like, how can you plan for that? Well, their tax was $0. They didn't pay a nickel in taxes last year because of where their income was coming from. We were able to sort of control their income. We took money from brokerage accounts. We took money from the pre-tax IRA directly to charity tax-free. And because of the larger standard deduction of about $30,000, it wiped out any tax that they would have had to pay last year. So there are ways that even if you are bringing in more income, if you can sort of control where that income is coming from, you can lower that tax bill and lower the amount of your Social Security being taxable. So let's start with a couple of the tax hacks that I have for you today. So the first one goes back to that example with that money coming from the pre-tax IRA going to charity. It's called a QCD. And a big tax hack is doing all of your charitable giving using a QCD. A QCD is a qualified charitable distribution. Now, it's only available if you're over 70 and a half, but if you're over 70 and a half, you can use this strategy. The big hack for this is if you're doing any charitable giving, to do that from your IRA. And if you're over 73 and you're taking your RMD each year, that QCD counts towards your RMD. So if you are a person that has pension income, Social Security income, and you really don't need that IRA to live off of, but you still want to do charitable giving, you can say, okay, I don't need my RMD to live off of. Let's just give that all to charity. Boom, that's tax-free. The next hack that I have is Roth conversions. And we beat this point home a lot, that Roth conversions can be a very powerful tool, but only if you do them correctly. With a Roth conversion, there are strategic times that you want to make sure that you're doing these Roth conversions. In market volatility, like we've been seeing lately, a Roth conversion can be really powerful. So for example, let's say you have $100,000 in your pre-tax IRA, and then the markets dip 20%. So now you're at $80,000. Now is a great time to do a Roth conversion because you can take that money out of the IRA into the Roth while it's down 20%. And then when markets recover, all of that recovery is tax-free in the Roth IRA. That's why it's important to always look at these Roth conversions throughout the year, and not just at the end of the year, so that you can strategically convert money when there is volatility in the markets. Now, Roth conversions don't make sense for everyone, so I'm not saying, hey, markets are volatile, do a Roth conversion. You have to make sure that it makes sense for your tax situation, that you're not just taking money out of a pre-tax IRA and triggering a bunch of different tax landmines to get money into the Roth. There are different ways that you can do that, and you should always analyze it and say, okay, I'm going to do this amount from an IRA into a Roth. What's it going to cost me in taxes? You should always look at that each and every year. The next hack I have is also another really good one for when markets are volatile, and that is something called tax loss harvesting. What tax loss harvesting is when you have a brokerage account. So that's an account that you're getting capital gains in, you're getting dividends and interest from, and when markets are down, you can sell assets in that brokerage account and buy something similar, and you sort of lock in that loss. So for example, if you have an S&P 500 fund, and that fund is down 20% this year, and let's say you just bought that fund last year, you can sell that fund and lock in that 20% loss, and then buy something similar. You can't just buy the same fund back. That's called a wash sale. You won't be able to take that loss. But if you buy a fund that's similar, that performs similarly, you can buy that fund, hold it for 30 days, and then buy your original fund back. What that does, let's go back to that example of $100,000, 20% loss. You can take that $20,000 of that loss and either offset any gains, or you can take that on your tax return as a $3,000 loss. Anything greater than that, you can just keep carrying forward to future years. With that in mind, the next hack I have for you is to manage capital gains. So you can always do the tax loss harvesting when markets are volatile and you have some losses in the account. But what happens when we have a few good years of up markets, or you have funds in there that you've owned for 10, 20, 30 years that have substantial capital gains? Well, if you're able to control your income, you can sell those funds for a 0% tax. So if you're single and your income's below $48,350 in 2025, or if you're married and your income's below $96,700, if you sell any funds with a capital gain, you're going to pay a 0% capital gain tax. So for example, if your income is low enough, you can just take some of the funds that have a gain, sell them, buy them back, and you don't have to pay any capital gains tax on that. That is a win-win right there. With regards to the capital gains, another thing to think about just in these brokerage accounts, a little bonus hack for you, is if you have a brokerage account, make sure that you are looking at the differences between mutual funds and ETFs. Mutual funds typically are less tax advantageous than ETFs because they will often pay out capital gain distributions at the end of the year. So always take a look and say, okay, is this mutual fund worth it over this similar ETF just thinking that ETFs are more tax efficient. So the next tax hack is to bunch charitable contributions. This is a strategy we use a lot, and I know a lot of people watching are thinking, what does bunching a charitable contribution mean? I just give to charity when I want to give to charity. And as you should. You should never give to charity for the tax purposes. You should really be giving to charity because that's something you want to do. And the tax advantage is secondary to that. But what bunching is when you take a few years of your charitable contributions and do them all up front in 1 year. Well, why would you do that? With the standard deduction roughly this year at $30,000, to itemize your deductions and really take advantage of those charitable contributions, you need to get above that $30,000 of standard deduction. So if you're someone with no mortgage, not a lot of medical bills, and your only big itemized deductions are your state and local taxes, those are capped at $10,000. And your charitable contributions, that means you need over $20,000 of charitable contributions to really get any advantage. For example, if you did $15,000 of charitable contributions, you would just take the standard deduction and get a higher deduction amount, meaning that your charitable contributions really didn't give you any tax advantage. So the goal of bunching is saying, okay, if I typically do 15 a year, I'm going to do 3 years worth up front and take that $45,000 deduction in year 1. Combine that with your state and local taxes, you're going to have a itemized deductions of $55,000. Now you take that big deduction up front, get a bigger refund or lower your tax bill, and then in the next 2 years, you take the standard deduction and you come out ahead than if you were just to do $15,000 each year for your charity. The next tax hack I have is for a health savings account. And this one goes for both retirees and if you're still working. An HSA is a very powerful tax saving account in the ways that if you're still working and you have access to an HSA through a high deductible health plan, you can make these contributions into the HSA pre-tax, and then these contributions grow tax-free within the HSA. And then when you're going to take them out, as long as they're for medical expenses, they're completely tax-free. You get a triple tax benefit there. Now, if you're retired and you no longer can contribute to the HSA, the benefit you now have is these contributions, if you're using them for healthcare, are tax-free in retirement. Doesn't mean that because you're retired you can't use the HSA. You can no longer just contribute to it. So the advantage of the HSA is you're retired and you say, okay, I don't really have a lot of medical bills. I'm never going to use up this HSA. Well, guess what? Your Medicare premiums count as a medical expense for the HSA. So if you don't have a lot of out-of-pocket expenses that you'd be using that HSA funds for, you can just go ahead and use the HSA for your Medicare premiums. You can't use them for your Medigap premiums, but your Medicare Part B premium, you can use your HSA monthly for that. Or if you're over 65 and you've got a ton of money in your HSA and you're using it for Medicare premiums, you still don't have a lot of out-of-pocket expenses, you can take distributions from the HSA without a penalty. You'll just have to pay taxes on those funds. So those are the top tax hacks that we have for the rest of 2025. These are things that you want to think about throughout the year. When we get towards the end of the year, there are a couple unique things that you want to make sure you're doing before the year ends. But these are the things you want to think about as we've seen recent market volatility. It might be time to take action on some of these items. Again, my name is Alec. If you have any questions, you can always reach out to me. If you are already a client, you can reach out to your primary advisor. Or if you're interested in becoming one, we'll have a QR code up on the screen, and you can scan that QR code to schedule a free introductory call with the Financial Consulate. Make sure you hit subscribe down below, and you can always stay updated on all the videos we have. And I appreciate you watching. Thanks.